This trading student was learning since 3 months without prior experience and made $1,520 using this 1-minute trading strategy. We will go through the trading strategy and also some key points and hope this will help your trading out. First of all, the money management is the most important thing because he's losing $100 in average and he's making $300 to $700 in average by trading futures, the S&P 500. You see here he has 11 losing trades and 7 winning trades and still made here $1,520. So the loss here is smaller than the money what he made. And he could even afford himself 10 more losing trades, and still make $500. So when going now here inside, this is the 1-minute chart. The main reason why we use the 1-minute chart is because it is easier to read the market. With reading, we can see 3 things, actually 4. That the market does more red than green candles, that the market does more length down or up if you want to trade down. That means here you see the length down is more longer than going higher. And you see also that the market starts making lower more and more candles, what is very awesome. The 4th one would be that the market is also moving from here to here, also lower, that you can see it with common sense. Because sometimes you see that the market has more length down than up, but still the market is flat. And this is a consolidation phase. Here is where we find a lot of losing trades, even experienced traders trying to trade in here. And I think it's totally fine when having the experience, but it's more better to see that the market was pushing up starting here. And once this all occurs, the market is aiming for either a smaller or a bigger structure low when trading down, a high when trading up, or a consolidation phase. I'm going to show you this one here in this video also. So in this case, you have here, the low here was here. You find here a low, here a low. By the way, it was his first month trading, right? So not to be too hard on him. This was in the end of the month is very important where he was getting better. And we will go here to the beginning where you can see like how he found like not that high quality trades using this trading strategy. So here you can see it is obviously going down and then it's about to aim for these lows. Once the market is aiming for this low, this is where it will go way more harder to trade in general. So what is very important is to trade to those references before the market is touching it, because trading down here is called a breakout trade. And this is where a lot of losing trades occurs. This is where trade quality is being decreased by 5 times having all these characteristics that I just said. So when just taking here a color switch before the market is reaching the low, this is where we find good trading qualities, especially red candles or green candles, depends on if we trade up or down. In this case, we trade down, so red candles are working more nicer. When trading futures, and this is a 2000, 3000 demo account, this is something that's very important. It is about to adjust $100 in average and to make $300, $500 or $700 for some winning trades. That we can afford more losing trades. That means when having this long red candle, like in this case, and to adjust $100 to sell so much that when placing the stop where the red candle is, the color switch, then if the market goes against us, we lose an average $100. But if the market goes for us, then we make $400, $500, $600. And in this case, it was a $400 trade. More lower, there was another trading opportunity. In this case, he's using an indicator that is called the anchored VWAP, and that's why it was like 1 and 2 color switches here. The red candle down here was more smaller, and the color switch itself too. So if he would have traded the second color switch, he would have made here $600, or even with the tighter stop placement, instead of placing the stop on the color switch on the highest point, the green candle, placing it on the red candle, it would have been maybe a $700, $800 trade even. But the thing is, of course, he has lack of experience and he just took the color switch, a very long red candle. And I think it's totally fine because it was his first month trading. By the way, I must also say that sometimes it makes sense to place the stop higher on the color switch, sometimes lower. This depends on how spiky the market is, in what angle the market is going, how aggressive. This is what we will also see soon here. So here you see how the market is going nicely down to this blue line, and then he exits the trade. Now the next day you'll find very similarity. That means you see here that the market is here in this consolidation phase, pushes out with a lot of green candles, does more move up than down, right? And some people start trading here already, but I think it's not that good. Letting the market more push out, and you can see how he starts trading here. He was even start selling here. I don't know if it was accidentally. Yeah, it was not accidentally. He just fell into maybe an old habit or something. With that, I mean just like you will see this later, by just trading without having a clear, having just clear key points for this trade, because here you see a lot of green candles, the market goes higher. You have this high here that is being reached already, what makes this trade not that good. But more higher, you have this blue line here, what is another high, a bigger structure high, what the trader was targeting. And you can see how the market here has your section number 1. It does less spikes, but here and there, the market is more spiky. And when you see that the market is more spiky, the stop placement on the lowest point of the color switch for buying is the best stop placement. That means red and green, lowest part is here. Red and green here, red and green here, right? Because sometimes when it's less spiking, we can just place it on a green candle itself. It's going to be tighter. It's going to be $100 or $300 more for the trade, aiming for a reference, sometimes even up to $500 more, what is a lot. But the thing is, if the market is more spiking, it's more important to put the stop where it belongs. You see here how he places it on the color switch, how he even sustains here the spike back and made here the $400 or $300 trade. In this case, it was just a $300 trade. It could have been a $400 or even $450 trade. And the main reason was because of hesitation. When seeing that there's a green candle, it is very important to work always with the timer. The timer you find using TradingView here on the right side, and it counts down using a 1-minute chart within 60 seconds. And 5 seconds or 3 seconds before a candle is closing, depends on how trending the market is. If the market is more spiky, as you see here, it is more better to wait around 5 seconds or 2 seconds before the candle is closing. If the market is more trending, then it makes more sense to use 15 or even up to 30 seconds or 25 seconds before the candle is closing. We can already see that the chance is more higher that this is going to be a green or red candle. In this case, he was waiting until the green candle is closing, and then he was entering the trade up here. So he had a 30% bigger stop placement, and because of that, he made $300, adjusted $100 down here. It could have been maybe a $400 or $450 trade, aiming for this blue line and then letting it push out what he did here, and then just exiting so good as possible. He was even giving the market a chance to run up. I think that's totally fine. And yeah, you can find here just like how he was trading here the trend. So this is also trending day. It is just not that nice. Now check this one out. Here you see again the same characteristic. Consolidation phase a bit. Market is pushing down here. And then it's getting more and more obvious. And then he starts adjusting your $100. And he made here, this was a, you see here how the trader here did, oh, I can't see that he didn't wrote down how much he made here. But this is like a $400, also $500 trade that you see here, adjusted $100 here. And then what the market starts now, the market was reaching here on the left side somewhere also a target. The trader sadly didn't draw this in because he's also in his beginning. It is his first month trading. It was like 3 months learning just how to trade. And the thing is that what is very important and what you can see here is that the market starts pushing up, and it does also more green than red candles. It does, the retracement had this length, and this length was way more longer than usual. Even though when placing something like an indicator, like an anchored VWAP and having your color switch, it is never just to trade the color switch. It is about to understand that there's a low somewhere where the market didn't touch, where the market didn't go at. And before the market is touching it, to press here inside the trade while having all these stuff like lots of red candles, more length down and moves, like just seeing that the market is more aggressive with these things, what I called in the beginning. And the thing is that here you see the market have reached already the goal, what he didn't know, and it does a lot of green candles, and then he had a couple of losing trades. On the practical side, it is totally okay to have 3, 4, 5, 6, 7 losing trades sometimes before the next winning trade occurs. It's just very important to understand why this is a losing trade and why there's less quality and why this one has more quality for this day here. Usually, trading at those days and having more losing trades here, I think is better than trading on these kind of days. Because now we're going to consolidation phases more, and where you can see the market is just flat. Here you see that the market also starts to make really more obvious move in one direction, more red candles than green candles. Even though the market does a couple of green candles, the trader punches here inside the $100 trade, loses $100, then he does the next trade and he makes here the $400, $500 here with this single trade. In this case, he made $400 within this trade. He didn't even trade to this low because he knew already that the market is just not that nice, but he was trading at the day and he made his money on the day. I think like those days, I think like even though when just having a winning trade doesn't mean that a winning trade is good. In this case, the trade had all the characteristics what makes a good trade, except that the market did here a lot of green candles. But I think it was okay. Especially also he placed the anchored VWAP. The anchored VWAP is cutting down here, you see. and then it is going to our color switch, and we say always above the uncode VWAP, you want to have the stop placement, what makes just a lot of sense. So let's go here to the next one. Here you see another worst day. You see here that the market is just flat, just in a consolidation phase. And this was in its beginnings. You see here how the market does a lot of green candles, and he's selling and he's selling and he's selling again. Starting here, you see that the market does more length down than length up, and you see also more red and green candles, but it's not obvious that the market is from here to here shifting lower. And when you look at the S&P 500 very often, it's not obvious that the market wants to go to this yellow area or wants to go to this yellow area, or at least just like here, this blue line. I don't know where the blue line is coming from. It makes less sense because this is the low here, and this is what the market is aiming at. Or just like at this yellow line here, what is the one-day VWAP, it didn't make any sense trading down here because you see here how the market clearly structures higher, and this is called price action, and it's to prioritize that the market is moving higher. On another day, you also see here how the market is now in the trend, but it's more spiky again, as you saw also on the other day. And I call this mostly like a falling knife. It is nice if the market is trending and going in consolidation phases and still going in one direction, but it's not nice if the market is trending up, being in a spiky consolidation phase, and literally spikes against our direction, and somewhere what is hard to foresee, anywhere just drops up. The problem is by trading this, we would always need to try to catch the bottom, and this is something what's very hard. And when trying to trade in the middle, it's almost impossible to squeeze in a risk-reward ratio of 5. That means by entering the trade after a green candle, if the trade goes against us, losing the $100. But if the trade goes in our direction, then to make $500, $600, $700, or even more at sometimes, it's just like very hard. So you see here down here, again, the consolidation phase, how the market is pushing out. A sign can be by that the market was touching here where my circle is the consolidation phase. This is already weakness. And then you can see now how the market also was before this high here. Check this out, just goes a bit higher, goes in, goes higher, and now check this out, goes back. So when trying to buy here, this is the problem. It's like a knife in the back, like literally it just like stops us out. So it makes trading here more harder, I think less good. So I think in general to trade on those days less, and better having more losing trades in these more trending and less spiky days. So even though this day here, it was a bit spiky, I think it's still not good having here a good winning trade, for example, too much. I think it's better to have here on less spiky days where the market is literally more trending down, and then just to place here more trades inside. Maybe like here, for example, having here a losing trade and then having here a trade that is running in our direction. This trade would have worked. Like just like these kind of things. Better having trading here using the uncode VWAP. It will cut in like this one, like a line here, but it's very awesome. Okay, let's just look here at, and this is very important also to understand this. He didn't have your proper money management in the beginning. He didn't have a clear trading setup what he was trading. Like he wasn't able to adjust $100 to make $500. He didn't have also clear targets. And it's always about this 3-step method. First of all, how does the day look right now? Can I see clearly that it goes in one direction and is targeting for a bigger structure high, low, or a consolidation phase? Second thing, can I see that the market does for trading up lots of green candles, for trading down lots of red candles, more length in our direction and less length against our direction? Third thing is that the market starts also to make more candles higher or lower, what shows us that more participants, they want to trade with more time and volume, it's called, in the continuation, like in the trend. And then what is also very important, by also having all these factors what I just named, you also want to see that it's obviously the market is going higher. If you can see that there's a high, and then each time the market goes above a high, it just goes back in and less move. Like it's just like not nicer than if you see that the market really tries to push out. What do you see, for example, here? What do you see, for example, also here, how the market strikes here above the high, and then we can also expect that the market is not going back here to this consolidation phase as an example. Let me know how much you were able to understand in this video. I hope this helps your trading out, which you all love. Good trades. JT out.